Everyone thought the system was stable, until it wasn't. Experts reassured the public, investors celebrated record highs, and governments claimed everything was under control. Then, in a matter of days or even hours, the illusion shattered. Money lost value, markets collapsed, and millions were left scrambling for answers. How could nobody have predicted it? Was it incompetence? Or something far more sinister? What if I told you the crash wasn't a mistake, but an inevitable consequence of the system itself? To understand a crash, you need to understand the system it destroys. Modern economies are built on a delicate web of credit, debt, and trust. Governments issue money, central banks control interest rates, and private banks multiply wealth through fractional banking. On paper, it looks orderly. In reality, it's a house of cards. Take the early 2000s housing bubble, and the US central bankers assured the public that low interest rates would fuel growth. And hedge funds and institutional investors poured billions into mortgages packaged as safe investments. Yet beneath the surface, a massive imbalance was forming, debt stacked on debt, invisible to most, quietly ticking like a time bomb. And no one stopped it. Not the regulators, not the economists, not even the media. Every crash begins with debt. But this isn't ordinary borrowing. This is money created out of nothing. Fractional reserve banking allows banks to lend far more than they actually hold. Governments then layer on additional debt, issuing bonds to fund promises they cannot keep. The first cracks appeared subtly. Housing prices soared, stock valuations became absurd, and credit markets hummed like a machine running too fast. Few noticed. Those who did were ignored. Bonuses, bailouts, and political influence encouraged the illusion to persist. Meanwhile, ordinary citizens were unknowingly financing their own financial peril. The system was rigged, but most people didn't even know they were in the game. As the bubble grew, everyone believed in perpetual growth. Mortgages were repackaged as complex financial products and sold to investors worldwide. Pension funds, insurance companies, and everyday families became entangled. The more leverage flowed into the system, the higher asset prices climbed. And with each rise, the perception of risk disappeared. Risk is only visible when the bubble bursts. By the time anyone realized the danger, the machine was already self-destructing. Then the first domino fell. A single sector, housing, tech, or sovereign bonds, began to fail. Panic spread faster than anyone anticipated. Banks that seemed invincible revealed massive losses. Credit froze. Money became scarce. Investors tried to sell, but buyers disappeared. The illusion of liquidity evaporated overnight. Markets plunged. Wealth vanished. The public realized a terrifying truth. Money is just a promise, a fragile one. Governments scrambled to contain the fallout. Emergency bailouts, stimulus packages, and interest rate cuts were deployed. But the system's design, built on ever-expanding debt, made the crash inevitable, not accidental. And while the world panicked, the people who created the system quietly profited. The human cost was staggering. Jobs were lost, savings wiped out, and entire economies contracted. Political instability followed. Some nations entered prolonged recessions, while others teetered on collapse. The crash exposed the structural truth. Crises always benefit the few at the expense of the many. Those with access to bailouts, cheap credit, and insider knowledge survived or thrived. Ordinary citizens were left to bear the brunt, financing the very system that betrayed them. The next time the system fails, history suggests the same pattern will repeat, only faster. After every crash, policymakers deploy familiar remedies, regulations, stimulus spending, and temporary austerity. Yet these solutions address symptoms, not the underlying architecture. Fractional banking persists. Sovereign debt grows. Financial instruments continue to obscure risk. In other words, the system is resilient, but only for those who understand its hidden rules. For the public, the next crash is already being written into the global balance sheets. The tools used to prevent collapse often ensure the next one is even bigger. Fast forward to today. Global debt exceeds $300 trillion. Central banks print money at record rates. Governments run deficits unimaginable even a decade ago. Stock valuations are extreme. Real wages are stagnant. Credit dependency is higher than ever. The patterns are eerily familiar. The same mechanisms that fueled previous collapses are active again. Optimism is contagious, while caution is dismissed as fear-mongering. History doesn't repeat exactly, but it rhymes. And in finance, those rhymes often rhyme with disaster. The question isn't if the next crash will happen. It's when and how deep it will cut. Here's what you need to remember. First, no system built on infinite debt is stable. Trust can be engineered, but it can evaporate overnight. Second, crises benefit the few at the expense of the many. Observe who profits and who pays. Third, patterns matter more than predictions. Studying the structure of finance often reveals inevitable outcomes before they happen. The next crash isn't a question of ifs, a question of when. Policies may delay it, but they cannot erase the fundamental paradox. Money created from debt will always demand a reckoning. Ask yourself, are you prepared for the day when trust in money itself falters? Have you found this exploration of hidden financial truths enlightening? Subscribe for more deep dives into the forces shaping our economy. Hit the notification bell and stay one step ahead of the next invisible crash. Remember, knowledge is the only currency that never loses value.